Most financial advisors and individual investors don't have the time to learn about technical analysis. But after reading the monthly macro tides and weekly technical review, you will have a better appreciation for the value of technical analysis and how combining fundamental and technical analysis can provide valuable insight. For financial advisors, it will help differentiate yourself from other advisors, help you retain existing clients and acquire new ones. For individual investors, you'll get greater peace of mind and, importantly, more confidence in the investment decisions that you make. Few economists or strategists combine fundamental and technical analysis, so they rarely see the whole picture. I have learned how to combine fundamental and technical analysis over my 40 years of experience, and that combination has provided valuable insights. Let's look at the 2007-2008 financial crisis as an example. In March 2007, I noted that banks had increased lending standards significantly, which would make it harder for companies to borrow and lead to slower economic growth. Even though the Federal Reserve was going to lower interest rates as the economy slowed in 2007 and 8, higher lending standards would negate the benefit as the banks tightened the nozzle. The red line is lending standards, and when the red line declines and falls below zero, it shows that lending standards are being tightened. The black line is the S&P 500. As lending standards were tightened, the S&P declined 57% from the October 2007 high. In 2008, the Federal Reserve continued to lower interest rates, but the banks continued to increase their lending standards, effectively choking off the liquidity that the Federal Reserve supplied. As you'll note in that chart, the same thing happened in 2001 and 2, when the S&P fell 49% while lending standards were being increased. When a ball is thrown up in the air at 50 miles an hour, it continues to climb even as the rate of ascent slows to 40, 30, and obviously eventually gets to zero, the ball begins to fall. The stock market is much like that ball. At the beginning of a bull market, the rate of ascent is really strong. Near the end, the rate of ascent slows. The irony is that slowing often happens against a backdrop of still good economic news. Technical analysis uses a number of measures to identify whether the stock market is getting stronger or weaker. As the S&P 500 made a new all-time high in October 2007, indicators like my proprietary major trend indicator showed that the upside momentum was weaker and the market was really running out of gas. Technically, the stock market was ready to fall, and fundamentally, as I noted in my March 2008 letter, the economy was already in a recession. Combining fundamental and technical analysis provides valuable insight. Another cycle, which is very interesting, is the 20-year cycle, going back to 1903. I'll review just a couple key points. 1942 obviously was tied to World War II. 1962 was the Cuban Missile Crisis. 1982 was a very important bottom. It came after a 16-year secular bear market in the stock market. 2002, the S&P had declined 50%, and it was after the dot-com bubble burst. And now that projects to 2022. So both the 80-year and the 20-year cycle suggests we're really entering a period of vulnerability that also could be quite tumultuous. And it brings into mind the traditional approach to investing, buying and holding. And I think as we go through the next few years, investors are going to have to consider whether that is the appropriate approach. The 80-year and 20-year cycle suggests that we're entering a window of time that could prove quite tumultuous and probably very volatile. My 40 years of experience is going to help guide you navigate this period of uncertainty and volatility. Thanks for tuning in. May something good happen for you today.